The Fed has not seen inflation at 2% since February of 2021, and it's still, according to the latest figures, 2.6%. Can the Fed lower interest rates when inflation is above its target level?
Yeah, it's been 50 months, Stuart, and hasn't hit that target. And guess what? Jay Powell didn't mention it in Jackson Hole at all, hitting that 2% target. So he's kind of flipped the script here in terms of getting back to 2%. The reality is we're probably not going to get back that low. That was historically low. If you look back like the last decade, we had historically low inflation. Typically, inflation runs around 3% since World War II. So I think we're actually at normal inflation now, and it's also giving Jay Powell room here to cut rates because he's not using that metric anymore.
At the moment, the market thinks there's an 87% chance of a quarter-point cut in September. That's not much, is it?
I mean, you definitely are spiking the punch bowl, though, because look, every piece of economic data you talked about today on this show has been positive, right? We revised up GDP growth last quarter. GDP growth is accelerating. We saw that real incomes and real wages have gone up. So everything right now looks pretty good from an economic perspective. Why does the Fed have to cut?
So if you do lower rates, you think you'll fuel a boom in the stock market? Another one?
We're already in the midst of a big boom, right? I think it's going to make it go even higher for sure because, again, you have a lot of cash just sitting out there on the sidelines that's going to come in if the Fed cuts because my 5% interest rate now is going to 4%, could now go to like 3.75%. Where's that money going to go? And I think that's where invariably you're going to see asset prices continue to rise here.
Wouldn't that be good? Ryan Payne, you have a great weekend.
Stuart,
thank you very much for
great to see you. Thank you.
Appreciate it.